All right, folks, this is what I'm supposing you should focus on today as a challenge. Okay, so here's $25,000 on a demo account. He's trading demo, this guy. All right, so we have a fair value gap that's defined on the 15-minute time frame. Let me show you what that is. So there's the same fair value gaps, okay? Now, what I'm going to do is I'm going to trust the fact that we have done there you go, I'm looking for my drawing instrument. We had this big drop down below the low of the lowest of the two fair value gaps defined on the 15-minute time frame. And then we have the higher one here. So I'm going to drop down to the 1-minute chart. I'm going to use these two fair value gaps to frame a setup. I'm going to look for price because we now taken out that low. We made it jagged. Where is it smooth? Right here. And just above that is what? The high of that fair value gap. So what I'm going to do is I'm going to watch and see if price can get back into this area here. I'll use the low of the 15-minute fair value gap to go long, and I'll exit there. Okay, so basically about 20 handles in price fluctuation. And I don't even need it to trade all the way back up to that one. This is not even required. So I can trade inside of a range, and it need not be all that impressive. Snoring puppies, always when I'm recording. You're probably thinking to yourself, why is this guy got his dogs always near him? It's the fact here, that's Piper. And Scout's right next to me, so she'll be doing her, she got a tongue sticking out. She'll be doing her snoring next too. So now think about it in terms of turtle soup. Okay, sell side below here is now being absorbed and engaged right there. Doesn't mean it can't go a little bit lower than that. This means that in my mind, I'm seeing that as they have now taken this liquidity. These sell stops are being engaged. Now, normally I would just go long on the basis of that. But using this context of looking for 15-minute fair value gaps and defining the range between two close proximity fair value gaps and using it as a basis for high frequency trading, we're going to wait for price to trade back above that low, and more specifically to that 15-minute fair value gap low, which 21,214.75 is. And then I'll go long there, and I'll target the 21,236 even level. Okay. And for the sake of completeness, I'll show you again what that fair value gap is. It's this. 2 p.m. May 30th, 2025. The range is that candle's high to that candle's open, because there's a small little volume bounce between the two candlestick bodies there. All right, let's go back down into the 1-minute chart and babysit this. So far, it looks pretty good. Looks pretty good. Okay, so my entire canvas as Bob Ross, the trader today, is this 15-minute fair value gap, high to low. So my entire range of opportunity is defined between these two price points. Right there. That's all I'm looking at. That's not complicated. Very, very simple. And I'm adding to it the idea that we have just recently taken sell side below 210. And I'm waiting for price to get right back into that 21,214.75 level. You'll also note that because that level is the beginning point, what else could I use to help frame that? Well, over time, you'll start noticing that you'll see this fair value gap. That should act as what? Inversion. So trading up, up into it, I can accumulate a long position, targeting that, and more specifically, to the high of the fair value gap on the 15-minute time frame. I was jawboning instead of entering the trade when I was drawing the fair value gap out. Whatever. It might give it to me. All I'm looking for here is to get below that area right there. It's like that. Yeah, give me a little bit more. There you go. Alrighty. Now let's define the risk. Trade it to there. You don't care about the R multiples of this. All you're looking for is the efficiency of using the very high of the fair value gap as your target, and then go through this range here. This range right here, from that low up to the low of the fair value gap at 21,214.75. Is there any gaps in this portion of price action? There's a volume imbalance, which right at almost at now. We gap down below it. So my stop is below this candlestick's low, and it's essentially the midpoint of the lowest bodied candle. See that? It doesn't need to be a big R multiple. It doesn't have to be like 3 to 1. It doesn't have to be 2 to 1. You're teaching yourself to use the logic of high frequency trading nodes between 15-minute fair value gap levels to subsequent higher or lower fair value gap. Submit yourself to the risk. Having a base model framework and foundation like this is not building precision, it's building continuity and consistency in looking for setups. Over time, once you start submitting yourself to this and saying, okay, there is price fluctuations that take place between the low, the high, the consequent encroachment, the high down to the low. These fluctuations take place all day long, but you've never noticed them because you've never been prompted to look at it. So while this suggestion for this week is not meant to provide you specific precision, it's meant for you to find a limitless supply of focusing on a very small canvas of price action that yields a plethora of opportunities that over time, using the other things I've taught, you can refine that and get very, very specific. For instance, like right here, we have the order block that just traded down into, okay? Because I'm teaching you to try to use the low of a fair value gap. And then if this was large enough to get to this level here, consequent encroachment, let's say, like for instance, say that was 40 handles. There's nothing wrong with that being your entire trade and not even trading up to the high of the fair value gap. You see what I'm saying? So you can make this as big or small as you want it to be. The control is in your hands. That's the beauty of using price action. You can structure the entirety of your model to suit you. But I gave you the context of using only one contract. You're not demanding precision. You're looking and studying how price moves from one discount to premium range, that transition or traveling from one band of discount to one band of premium. This fluctuation between those two price points, that's what I'm teaching you to look for, because you're going to find that they form so many times intraday in one session. They form multiple times over the course of a week. And when you get comfortable with knowing that those types of setups are always there, you're not going to fear missing a move. You're not going to be greedy. You're not going to be fearing this is the only trade I'm going to find today. This is the only trade I'm going to find this week. You know, I'm watching these other people and they're making this much money and they're this, they're that. Stop doing that. Stop doing that. Put your nose down into the charts. And now, because I give you this, it gives you a very small little canvas. The only thing you're worried about, not that I should be using the word worry, but let's keep it in constructs of what it is for a new trader. You're worrying. You have anxiety. And the way you combat any form of anxiety is stop trying to live up to everyone else's expectations of what you should be doing or should not be doing. If you never invite anybody outside yourself to what it is that you're doing as a trader, or what you're testing or what you're developing or working with as a model, learning to trust, you'll never have the anxiety. You'll never have that anxiety. If you never share with your coworkers, your family members, the people online, what it is that you're trying to do, they'll never have the opportunity to talk you out of it or make you feel like you're not doing enough or you're not progressing at an optimal or reasonable state of progress. This whole idea is for you to look at these reoccurring price fluctuations, and they need not be extrapolated. You can use, like for instance, this fair value gap here, I'm using it because it's essentially 20 handles. 20 handles to me is the minimum threshold before I even consider taking a trade. Now I can use smaller ranges, but for me personally, my personal tastes and the way I value my time over price action is I'm not willing to take a trade that I can't at least make 20 handles on. And I could do a whole lot less, but for me, it doesn't make any sense for me to assume any kind of monetary risk or spend any time on anything less than 20 handles. And the way I'm telling you that I'm framing it on the basis of 20 handles is because from the low at 21,214 up to 21,236, that's basically 20 handles. It's a little bit more, but it's basically 20 handles. So all I'm teaching you to do is get comfortable with the idea of looking for 15-minute fair value gaps to define a very specific range that you can trade in, and drop down to a 1-minute chart, and you'll see over and over and over again so many opportunities and trades. Now, see what we've done? We've taken out that low with all this movement here. So all those sell stops have been accumulated. Now, where would smart money want to unload or offset those purchased sell stops? Well, look at this. That's where the buy stops are. And wouldn't you know it, what's convenient? The high of the fair value gap on the 15-minute time frame at 21,236 right here. And that's where my limit order is. So beyond the measure of where the buy stops would be sitting, there's layered buy stops. Okay? And I only needed to trade to 21,236 and not a tick higher. I'm just aiming for that high of the fair value gap. My stop loss, once we get above, on a closing basis, the consequent encroachment, I'm watching that. Then I'll take the stop and I'll bring it up to like here. Okay? But all you're doing is you're training yourself to look for fluctuations that are high frequency trading in character. What they're doing is they're delivering price action over that range. That's all based on inefficiencies. It's not complicated. It's not complex. It's very, very simple. But you can take this idea of using 15-minute fair value gaps and executing on 1-minute charts, and you can make them extremely complex models. It doesn't mean complex in a sense that it's hard to trade. It just means that it's extremely precise and surgical. So see if we can get this candlestick to close above the consequent encroachment at 21,225.50. 2 seconds left. Bam. Thank you much. All right, there we go. Stop loss has been reduced a little bit. So now we're going to submit ourselves to whether or not it comes back down to the low and into that volume imbalance there. It's reasonable to see it do that. It's preferred that it doesn't. We want to see it go above these highs where there's minor buy side and then tag that 15-minute fair value gap high. And yeah, I already know some people are just buzzing right now. They can't wait to go on X and post this. This is ridiculous. First, he's trading with a demo account. Two, he's only looking at $365 as a profit. Yeah, and I thought like that. In 1995, when I was learning from my real first mentor, when he was talking about his systems, Larry Williams is who I'm referring to, by the way. He had lots of stats and very generic numbers that his trades, winning trades, would be anywhere between $375 a trade, or contract rather, to $500 to $600. And rarely was it larger than that. And I thought to myself, like, this is the guy that made $10,000 turn to $1.2 million. And I always phased that type of conversation about trading and what he was teaching there. I kind of like put blinders on and said, I'm not impressed by that. Like, I didn't get into trading to make $300. I got into trading to make thousands of dollars, So, but as a beginning basis, if you can find $365 3 times a week, how would that impact your money that you require to make your ends meet, your bills, to pay your bills on a monthly basis? If you could do that 3 times a week, wouldn't that make a huge impact? It may not cover everything, but if you're brand new and you're just now learning how to do this, doesn't it give you a little bit of hope that because of inflation, because of things being so expensive, that it would help alleviate not only the necessity for you to feel like you got to do more, or you're not successful, or you're not finding success, or progressing in a manner that would be accepted by the public. Okay. When I started thinking to myself, okay, when this guy was talking about making $375 a trade or per contract, and then come to find out he's trading 2,000 contracts. Okay, then now, yeah, it makes a whole lot more sense. So he's looking for these little cookie cutter. And it wasn't until years after trading and trying to, refine certain things, I started going back to his old stuff. I'm talking literally like 1997, 1998, that I was like, man, if I started applying these ideas on a larger scale, where my trade ideas are way beyond that. Like, I can frame trades that are $5,000 per contract winners. And then you scale that up with money management, how much you can afford with your equity and how many contracts you can control and leverage. But you never need to over leverage, and you never need to worry about running out of setups. You never need to subscribe to some signal provider. And you don't need to think about what other people think about as my content being complex or complicated. I don't overcomplicate anything. It's the students that always overcomplicate it, or the individuals that don't really know what they're talking about when they just see one video or two, and they think, wow, this guy's merely making it complex. They need to sell you that idea, because they're many times trying to sell a course, some kind of a service, some kind of a product. They have to draw a strong, harsh contrast to the things I'm teaching. Otherwise, they don't have a stage to stand on to sell their stuff or draw attention to themselves. What I'm showing you here this week, where you can literally frame this whole idea of looking for setups on the simplicity of using 2 15-minute fair value gaps that are in close proximity. Put the 6 levels on your chart, the highs, the consequent encouragement, and the low of 2 fair value gaps that are formed on a 15-minute time frame. And then watch and study the fluctuations over the course of the trading session, the trading day, the trading week. And literally, you will never run out of setups. You'll never run out of setups. And you not need to worry about the daily bias. You don't need to worry about the narrative, but this helps you in developing an understanding about narrative. It helps you understand about daily bias in the beginning when you don't know anything about it, because it tells you how to go into price action and study very specific ranges. And you don't need it to be a breakout. to be a trader. You don't need to wait for a breakout. I don't need to trade above 21,236 to be profitable. You don't need to see breakouts. It can trade inside of a range and yield all the money you'd ever need to live well. Notice I didn't say rich, because when I talk in terms like that, because you're selective in your hearing, your brain's going to say, oh, he just promised me that I could trade this and I'm going to get rich. That's not what I said. I said that you're never going to run out of setups. You're never going to not have the ability to frame logic without needing to know the daily high and the low, without needing to know the draw and liquidity on weekly ranges. You don't need to know all that stuff. In time, it's beneficial if you do. But what do you do right now? Your first day as an ICT student, what should you do to go in to see that these things repeat? How to prove to yourself in one day that price moves algorithmically. It's an exercise like this, where it completely strips away all of the requirements that the public, the detractors, people that sell stuff that's not what I'm teaching, they have to have those types of things to market themselves. When you submit yourself to these things, you'll see that they deliver, and there's no reason for you to fear missing a trade or not knowing what the high and low is. You don't need to know that stuff. You don't need to know any of those things. But notice how we just took out that high, or those highs right here, and went right to the high of the 15-minute fair value gap. Perfect. This right here, this whole fluctuation in price action literally is more than most people trade successfully when they're trying to trade these prop accounts and try to pass their challenges or whatever, because they're trying to get grand slam home runs. They think that that's the secret. I have to get these big trades and I have to trade with big leverage. Bullshit. No, you don't. All you need to do is know what you're trading on. What's the framework that you're using? What is the whole basis for it? And I just realized that I don't see the executions. So again, I'm going to show you again. This was done as you should be doing this week, paper trading it. And the setups, executions are right there. All right. So there's it. Trading using the low. And it need not even be the actual level. You can get real close to it. So the low is 21,214.75. The fill was at 21,217.75. So there's 3 handles difference. The drawdown from entry to that low. Well, let's see what that low is. Low comes in at 203.5, right? Am I correct in that? 203.5. So 14 handles drawdown. And that's reasonable because we're using the basis of the fair value gap low on the 15-minute time frame as the entry. It has to be there, targeting the high of it. Why? Because from the low to the consequent correction is not 20 handles. So using my logic, I have to have a range that yields at least 20 handles to me, because if I capture 15, that's okay. It's worth it for me to take 15 out, because that gives me some fluff, some wiggle room, the entry and the exit price. I don't need to be perfect. So 20 handles gives me that range of opportunity to take out net gain 15 handles. You understand what I'm saying? So if it were to suggest by the 2 fair value gaps I outlined this morning, let's say, for instance, from the low of this fair value gap up to the midpoint between this fair value gap and the high of this one, that was 20 handles. From this low here up to this price point, if that was 20 handles, then that would be my range. This would be like, it's going to draw up into that, but I need it not to trade there. In other words, I don't need it to do that. It's likely, but I don't need it to do that. And this is how you start as an infant in reading price action with my concepts. It's not complex, folks. It only seems complicated because you're trying to apply everything you heard about me, every other thing I've ever talked about in a video, every other PD array. You're trying to find a hole for that peg to fit into, in addition to whatever I'm asking you to look at right now. And you complicate it. You as the trader, you as the listener, you as the practitioner. You're all trying to be black belts on your first day, and you don't even have a white belt around your waist yet. That's equivalent to what it is that you're trying to do. You're expecting yourself to be a gold medalist in the Olympics, and you've never even learned how to do that skill or that sport or that event. You've never done it before. You've never thrown a shot put. You've never thrown a javelin. But you expect to walk out there in the Olympics and get the gold medal because you applied yourself and put your attention on it that given moment. That's the fallacy. Not just with my content, but anybody that's teaching trading education. Everybody has students that come to them, and it's the majority of them. They come and they bring their own preconceived notions and ideas about how they should learn because they know everything. Coming to the teacher as a student, and they want to be the teacher. Teach me this way. Well, that supposes they understand the subject matter when they don't. And the subject matter is themselves. They have to first find themselves, discover where their weaknesses are, and prune all that stuff out and make themselves teachable first. Then by following rules and protocols and procedures, then they can start to flesh out a model, consistency, building encouragement, and seeing these repeating phenomena that take place over and over and over again. And when you identify what I'm showing you here this week, you're never going to run out of setups. You're never going to worry about the things that you're worrying about right now. All these arguments that people outside of our community make are completely moot when you start like this. You strip it down. As I taught it, you just take one PD array and you use it on the basis of premium to discount. And then what is the opposite end of the range you're looking for? And you don't need it to trade outside the range. That's one of the biggest lessons I taught when I was on baby pips. Trading inside the range. And you don't need it to trade outside the range. You don't need to be a breakout trader. Breakout trading is for neophytes. These are noob traders that are doing that because they don't know how to buy before the breakout. They don't know how to sell before the breakout because they don't know how to trade inside the range. The easiest way to learn how to trade inside of a range is what I'm showing you right here. This is exactly what I sat down with one-on-one teaching. This is what I made them do. This is what I made them do for the week. This is the thing that I forced them to look at. I forced them to look through the lens of the 50-minute time frame on close proximity fair value gaps and just use that as their range. That is their predetermined canvas. That's the only thing you can use. These are the levels right here. The lowest of that fair value gap and the high of that fair value gap. It was formed on the 15-minute time frame. At the time I came on to X this morning, that's what we were all seeing in our charts. That is the only fair value gaps that were in close proximity. Period. End of story. There's no ambiguity there. There's no fluff. There's no why didn't you pick this one? It was very, very finite. And that's how you have to be with rules and procedures and protocols and models. You have to be able to make a definitive determination about what it is that you're going to focus on. What makes your range premium? What makes your range a discount? Well, my PD arrays assist in that. It's not subjective because they're very specific, 6 very specific price levels. The high, the low, and the midpoint. That's it. I've already stated that if you would have added the not the consequent encroaching, but if you would have added the quadrants, watch, look what happens when you start doing that. This video is already getting too long. They may not even let me post it. That makes me angry when I do that. Where am I at here? I'm looking for the... Why are my eyes not working right today? There we are. There and there. Good grief. All right, so here's the lower quadrant. There. Look where it was used here. And look how it was used there. 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 Look how we spiked down below it, and the bodies respected the lower quadrant. These are all signatures. It helps you build and understand how price is going to behave. And there's the stops I told you that it was going to run. There's the accumulation of those stops, and then attacking the buy side here. And above that is the high, that fair value gap. And we traded right to the midpoint, and I'll just rough it real quick. From that level to that level, right there. This is event horizon between two PD arrays, midpoint. And look how perfect that is. Look at the body. Look, seriously, you're going to tell me the body stopping right there, right at that specific level, the buying and selling pressure disagreed to do that? Enjoy your day.